Most people think investing is about finding the next magical stock that will make them rich by next summer. They listen to a friend, a banker, a random guy on TikTok, and then they are surprised when things go wrong. Well, in this video, I want to do something different. I'm not going to show you a secret formula, I'm going to walk you through the 5 real companies that I personally find interesting for the next few years up to 2026 and beyond. By the end of this video, I don't want you to copy a portfolio, I want you to think, okay, now I understand why some businesses are stronger than others and why I should stop buying random crap just because it's trending on social media. The 5 names look very different on the surface: luxury cars, electric vehicles, healthcare, software, and coffee. But all of them tell us something important about how money and power work in the economy. And if you watch all the video all the way until the end, I will have a gift for you. And of course, let me be clear, none of this is financial advice. I am not your banker, I am not your financial advisor, and I don't want to be actually. I am just an economist and an investor intending to give you a brain, not like a shopping list. With that said, let's start with the first stock, that is Ferrari. Everyone knows Ferrari. Red cars, Formula 1, Italian drama, impossible waiting lists, but almost nobody really talks about Ferrari as a business. And I think that's a mistake. Ferrari is not just a car company, it's a luxury brand that happens to build cars. And that makes a big difference. A normal car company tries to sell as much units as possible, but Ferrari does the opposite. They limit production on purpose. They sell fewer cars, but at a much higher price and with much higher margins. Think about it, if everyone could buy a Ferrari easily, it would stop being special. Scarcity in this case is not an accident. Scarcity is the product. You're not buying a car, you're buying the entry to a very exclusive club of people that own a Ferrari. And that is the true value of this enterprise. This is something that people in finance love: pricing power. That means that they can raise prices without losing their best clients. As long as the brand stays strong and its name stays strong, they don't need to chase volume like a mass market brand. They can simply focus on protecting the dream. This makes Ferrari a very good investment, but does that mean that Ferrari is automatically a good buy at any price? Of course not. The risk with Ferrari is exactly that. The market already knows how special it is. The stock often trades at very high valuations because investors are paying today for many years of future growth. But let's take a look at the charts. Right now, Ferrari is down more than 30% from its all-time high, which removes its biggest handicap, the price. So should we all run and buy it right now? Well, it wouldn't be a mistake, but it wouldn't be necessarily the smartest decision. A 30% drop is already interesting in my opinion, but personally, I'd like to see the price closer to the 300 euro area that you can see right here is the one that I marked, unless the chart shows a very clear reversal before that. And that is exactly what I'm going to do. I'm going to wait for the price to come to this zone that is right here and start accumulating and buying, in this case, the stock Ferrari, because I think it is a very, very good enterprise for the long term. Now let's move to the second company that is in my list. In this case, it is BYD. And this company is just different. BYD started as a battery company for Apple. They were not born as a classic car manufacturer, and that matters because electric vehicles are not really about leather seats and chrome. It's about batteries, cost, and scale. Most people only see BYD as another Chinese EV maker, but that's a lazy thinking. BYD is not just a car company, it's a battery and technology company that also makes cars. One of the reasons I like BYD is its innovation in batteries. While other brands are still struggling with batteries, BYD continues to push new batteries technology and ultra-fast charging solutions. We're talking about the ability to recharge a battery to around 80% in just 5 minutes. If this kind of technology scales, it completely changes how we think about electric cars. On top of that, BYD is not stuck in one market, it is expanding in Europe, Latin America, and Asia, signing deals, opening factories, and slowly becoming the biggest car company in the world. Looking at the charts, we identify all these potential entry points based on key liquidity levels marked with these white lines. What I would recommend here, because you are also exposed to a more volatile currency like the yuan, is to buy small positions at each of these white levels instead of trying to guess the perfect price. This is called DCA, dollar cost averaging. If you have no idea what DCA is, or if you want a simple step-by-step explanation, I made a full video about it that you can check it on the card up here, or you can just save it to watch it later right after this video. But are there any risks? Is it perfect? Well, of course there are risks. First of all, it is exposed to China. This means regulation, price wars in the EV space, but the reason I include BYD in this video is simple. Because if you believe in the long-term growth of the electric vehicle and the battery technology, BYD is the company you want in your portfolio. And that gives it a very special place in my watch list for 2026 and beyond. By the way, remember that if you stay until the end, I'll give you one last company that looks boring on the surface, but is one of my favorite cash machines. Now let's go to a very different planet, healthcare in the United States. Our third company is UnitedHealth Group. It is not a sexy brand, you don't see people on Instagram flexing their UnitedHealth membership, but economically this is a solid enterprise. UnitedHealth is one of the largest health insurance and health services companies in the world. It makes money in a system that is incredibly complex, incredibly expensive, and often incredibly unfair. And precisely because the system is so broken, companies like UnitedHealth have become very, very powerful. Moving to the charts, we see this massive fall of over 50% in the stock price in exactly 1 year. This fall makes the actual price very attractive to buy, and apparently Warren Buffett agrees with me, as he has already bought through his company Berkshire Hathaway over 5 million shares, giving this idea a more solid foundation. But you may be asking to yourselves, will it recover? Well, unfortunately, as long as the system survives, companies like these will continue making money. But I do think this is one of those rare moments where ordinary investors like you and I can also profit from a machine that usually only benefits big institutions. Now, let's move on to the fourth stock on the list, that is Adobe. Adobe is basically the company that taxes creativity. Anytime someone edits a photo, cuts a video, designs a logo, or signs a very serious contract, there is a very high chance that Adobe is somewhere in the middle, quietly charging a subscription. What I like about Adobe is that it doesn't just sell software, it sells infrastructure for the digital economy. Photoshop, Premiere Pro, Adobe Acrobat, After Effects, Illustrator. These aren't nice-to-have tools, they are industry standards. Studios, agencies, and companies around the world build their entire workflow around them. And once a business is locked into the Adobe's ecosystem, it doesn't just cancel from one day to the next. That means recurring revenue, strong pricing power, and very healthy margins. On top of that, Adobe is not sleeping while AI grows. It is integrating AI into its own tools. Things like generative fill, smart editing, and faster workflows instead of pretending nothing is happening. Now let's look at the charts again. We see that the stock price has fallen over 50% since its all-time high. But does that make Adobe cheap? Well, let's say it is starting to approach a support zone I really like for the long term, between $275 and $320. And actually, I bought some on Monday. And if you believe that the world will keep creating more content and more videos and more documents and more digital work, then owning the company that runs a big part of that creative infrastructure can make a lot of sense in a long-term portfolio. While working on my videos, I enjoy drinking my coffee, but I don't want a simple coffee, I want to feel special, as if I were part of something bigger, and as if I were part of a community. And this is exactly what our fifth company represents. Our fifth company is Starbucks. Starbucks is basically a daily live subscription disguised as a coffee shop. People don't just go there for caffeine, they go for the routine, for the atmosphere, for the Wi-Fi, for the feeling of this is my spot. And that is very powerful because it creates something that every investor loves: habit. When a brand becomes part of someone's routine, price increases hard less, and loyalty lasts longer. On top of that, Starbucks has a huge global presence, especially in the US, and is still expanding in the high-growth markets like Asia, where a Western coffee culture is still growing. What I like from an investor point of view is the combination of brand, scale, and cash generation, as Starbucks doesn't need to reinvent itself every year. It tweaks the menu, plays with seasons with special coffees like the pumpkin spice latte or the Christmas specials, builds loyalty through its app, and uses all this data to keep people coming back. That app, by the way, is not just a nice feature. It's one of the strongest loyalty ecosystems in the sector, with prepaid balances that, in practice, work almost like a free loan from customers. Actually, I believe that some years ago, Starbucks did one of the best business moves in history with this app. Looking at the chart, we can see that I bought Starbucks at the price of $74 represented with a white line and sold it at around $93 represented with the green line. Actually, Starbucks is the first stock I ever owned, and I have a very special love towards it, so what I will do is to wait for the price to come back to the zone of around $75 to reincorporate the stocks to my portfolio. This is what I would do, and this is, in my opinion, the best move if you want to buy Starbucks, but well, it has already a good price right now. But I will wait for this price to come back to $75. Now, as I am man of my word, it is time for your reward for staying until the end. One last company. Nobody knows about this, but it's Edenred. You probably don't see it in YouTube thumbnails with fire emojis, but that's exactly what I like it. Edenred is a French fintech specialized in things like meal cards, employee benefits, fuel, and mobility cards and payment solution for companies. It sits in the middle of a huge flow of money between employers, employees, and merchants. It doesn't need to build factories, it doesn't depend on one single product, and once a company integrates Edenred into its systems, it's very hard to leave. That means long-term contracts, recurring revenue, and very predictable cash flows. While Ferrari gives you brand power and BYD gives you innovation and growth, Edenred gives you something quieter. A scalable digital business that just keeps processing payments and adding clients in different countries year after year. It is not the flashiest name in the portfolio, but sometimes the best gift for an investor is exactly that. A boring-looking machine that never stops printing cash in the background and that is helping us diversify our risk and the risk in our portfolio. If we look at the charts one last time, we can see a devaluation of over 70% as the stock price is entering the buying zone that I marked between the 16 and 19 euros. I believe that this could be a good entry point for the long term and that could help our portfolio to be more diversified and a bit more secure. You don't need to own these 6 stocks, that is not the point. The point is to train your brain to ask better questions. Instead of which stock will go up next week, ask what is the real engine of this business? Who pays? Why do they keep paying? And what could break this machine? If you want to invest for 2026 or any year, you have 2 options. You can gamble and hope, or you can study real business, understand their strengths and weaknesses, and then decide calmly where you put your money. And if you want to keep learning for free instead of paying some clown in a suit working for a selfish and fucking disgusting bank, you know actually what to do. Like, subscribe, and use your brain, and if you do that, it is already a win for me. And if you want to go one level deeper and understand how I actually buy into this kind of companies over time, check out the video I've linked about DCA, dollar cost averaging. It is on the card above and in the description, so if you made it all the way until the end, please let me know by leaving a comment with your favorite company or the company you'd like to see analyzed next. I'll see you in the next video. Ciao.